Hello and welcome to my channel. This is Sama Kadi. I'm a professor in marketing. Today I want to cover the contribution margin, the concept of contribution margin and how calculate it. Let's go ahead and get started. Contribution margin can be stated on a gross or per unit basis. It represented the incremental money generated for each product or unit sold after deducting the variable portion of the firm's cost. So contribution margin is computed as the selling price per unit minus the variable cost per unit. As we said, contribution margin is the deduction between the revenue and variable cost. Contribution margin shows how much money is available to pay the fixed costs such as rent and utilities, which must be paid even when production or output is zero. Contribution margin provides managers with an income statement that clearly distinguishes between fixed and variable cost. Marketers use contribution margin because it's great for planning and decision making. Let's practice contribution margin formula together. As you can see in this example, contribution margin equals net sales minus the total variable expenses. We have in this example the variable cost 150,000 and the quantity 500. So the total cost per unit is 300, which is 150,000 divided by 500. As you can see, the total cost per unit is 300. Contribution margin per unit, as you know, revenue per unit minus the variable cost per unit. So based on this example is 500 minus 300, which is 200. So the contribution margin per unit is 200. So I wonder, how is the contribution margin? Contribution margin, or the total contribution margin, is sales minus the variable cost. Based on this example is 250,000 minus 15,000, which is 100,000. So the contribution margin for this example is 100,000. If we need to go further and we need to see what is the net profit. The net profit is the contribution margin minus the fixed cost. Based on this example is 10,000 minus 80,000, which is 20,000. The contribution margin ratio is the difference between a company's sales and variable cost, expressed as a percentage. This ratio shows the amount of money available to cover fixed costs. As you can see in the formula, contribution margin ratio is a contribution margin divided by sales, or contribution margin ratio is total revenue minus the variable cost, which is the contribution margin divided by the total revenue. So the contribution margin, we got it from the previous slide, as you remember. So again, the formula for contribution margin ratio is the contribution margin divided by sales. And based on the previous slide or the previous example, we have the contribution margin, we got it as 100,000 and we got the sales 250,000. So 100,000 divided by 250,000, which is 40%. This is the contribution margin ratio.